Welcome back to Plain. Explain the place where complicated ideas become simple stories anyone can understand. Today we're decoding something that silently controls major parts of your life, your credit score. It affects your loans, your interest rates, even your ability to rent a home. But most people don't know how it actually works. So let's break it down together, piece by piece, in the simplest way possible, and reveal the truth behind the mysterious number that decides whether the financial world welcomes you or holds you back. Imagine this for a moment. You can walk into a store, buy a $1,000 phone in under 5 minutes, and walk out without paying a cent up front. But if you ask the bank to lend you $5,000, suddenly it's as if you're applying for citizenship on another planet. They want documents, history proof verification, and time. And surprisingly, everything comes down to a single number. A number that silently defines whether you're seen as trustworthy or a financial risk. And most people don't truly understand what that number even means. That number is your credit score. More specifically, the FICO score. And today we're going to break it down in the simplest way possible. No jargon, no confusing math, no scare tactics. Just the truth explained like you've never heard it before. Let's start at the core. Your credit score is not a measure of how smart you are. It's not a measure of how successful you are. It's not even a measure of how much money you make. Your credit score is simply your financial reputation. Think of it as the trust rating that lenders use to decide whether they believe you'll pay them back. In school, you had a conduct score. Online, you have a reputation score. In finance, this is the credit score. Nothing more, nothing less. But here's the twist. You don't control that number directly. You influence it through habits, patterns, and decisions you make with borrowed money. And the system watching you, FICO, is used by roughly 90% of lenders. That means mortgages, car loans, credit cards, even some rental applications. All revolve around FICO. So the real question is, how does FICO decide whether you're trustworthy? FICO is built around 5 simple ingredients. And once you understand them, the entire credit system becomes almost predictable. The first ingredient and the biggest one is payment history. This makes up 35% of your score. In the simplest terms, do you pay your bills on time? Every time you pay late, miss a payment, or let a bill go to collections, it leaves a footprint on your record. Lenders look at this just like you would look at a friend. If you have a friend who borrowed money 10 times and repaid you 10 times, no stress, no excuses, that friend is trustworthy. But if another friend borrowed money twice and forgot to pay you back both times, you would think twice before lending again. FICO works the same way. Reliability is king. The second ingredient is credit utilization. This makes up 30% of your score. Credit utilization simply means out of all the credit you have available, how much are you using? Imagine you have a bucket that holds 100 liters of water. If you fill it to 90 liters, the bucket is close to overflowing. That makes people nervous. But if you only fill it to 20 or 30 liters, everyone relaxes. With credit cards, it's the same. Lenders feel safe when you're using less than 30% of your available credit. It tells them you're responsible, calm, and not desperate for money. Now, the third ingredient, length of credit history. This makes up 15% of your score. This is the age of your accounts. How long have you been playing the financial game lenders trust someone they've known for years more than someone they just met? If you just opened your first credit card last month, lenders see you as a stranger. They don't know your habits yet. But if you've had a card for 5 years or 10 years, they can see your patterns. They can see your ups and downs. Stability over time matters. That brings us to the fourth ingredient, credit mix. This makes up 10%. This one is simple. Lenders want to see that you can handle different types of debt. Credit cards, car loans, student loans, personal loans, mortgages. Just like a balanced diet shows you know how to take care of your health, a balanced credit mix shows you know how to manage multiple responsibilities. You don't need every type of loan, but having more than one type helps. And finally, new credit. Also, 10%. Every time you apply for a new loan or credit card, The lender checks your credit through something called a hard inquiry. This temporarily lowers your score by a few points. Too many of these in a short period tells lenders you might be struggling or desperate for money. It's similar to applying for too many jobs at once. You start raising questions. Those are the 5 ingredients: payment history, credit utilization, length of credit history, credit mix, and new credit. Once you understand these, the entire credit score system becomes transparent. Nothing is random. Nothing is hidden. It's simply a reputation score that evolves based on your habits. But credit scores come with many misunderstandings. So let's clear up a few of the biggest myths. Myth number 1, having a high income means you'll have a high credit score. Not true. Income does not directly affect your score at all. You could earn $10,000 a month and still have a terrible score if you miss payments or max out your cards. You could earn $2,000 a month and have an excellent score if you manage your credit responsibly. The score is about behavior, not wealth. Myth number 2, closing old credit cards will raise your score. This is one of the most damaging misunderstandings. When you close an old credit card, you reduce your total available credit, which makes your utilization shoot up. You also shorten your credit history. Both of these hurt your score, unless the card has high fees or a specific reason to close it. Keeping old accounts open is usually beneficial. Myth number 3, paying off all your debt instantly fixes your credit. Not exactly. While paying off debt is amazing, credit scores don't update overnight. It takes time for credit bureaus to receive new data and recalculate your score. And your history, good or bad, still remains for a while. Credit is not about being perfect. It's about being consistent over time. Now that we've cleared the myths, let's talk about how to actually improve your score. Not vague advice. Real steps you can take. First, always pay everything on time. Set reminders. Automate payments. Even one 30-day late payment can drag your score down for years. Think of on-time payments as the heartbeat of your credit. Second, keep your credit utilization under 30%. If you have a total limit of $10,000, try not to use more than $3,000. And here's a powerful trick you can lower your utilization without paying off debt, simply by asking your credit card company to increase your credit limit. If they raise your limit from $10,000 to $15,000, your utilization percentage drops instantly and your score rises. Third, keep your oldest accounts alive. Age matters. Old credit cards are like old friendships, don't throw them away without thinking. Fourth, avoid applying for too many new cards all at once. Space them out. Let your history grow naturally. Fifth, if you have multiple debts, start by clearing the small ones. These are easier to eliminate and create quick improvements in your score, which is motivating and financially freeing. And here's a bonus insight almost nobody talks about: credit is less about money and more about trust. Lenders want to see that you behave predictably. Credit scores reward stability, consistency, and self-control far more than they reward wealth. But where does this system come from? Why do we trust a 3-digit score so much? Before credit scores existed, lending was personal. Banks judged people based on reputation relationships, family names, or subjective bias. It was unpredictable and often unfair. FICO, created in the 1950s, was designed to remove bias and replace it with math. It didn't eliminate subjectivity entirely, but it gave everyone the same starting point. No matter your background, you could build good credit by building good habits. That was the promise. And whether the system is perfect or not, it affects almost every major financial decision in your life. Buying a home, financing a car, starting a business, renting an apartment, sometimes even getting a job. Which means understanding credit isn't optional anymore. It's essential. The interesting thing is, once you understand how this system works, you start seeing your credit not as a score, but as a story of decisions, patterns, and trust. A story where your future is shaped not by the mistakes you made in the past, but by the habits you build today. So here's the most important lesson of all. Credit is not about being rich. Credit is not about being lucky. Credit is about discipline. It's about showing month after month that you can make small, consistent decisions. The kind that prove stability. The kind that build trust. The kind that open doors instead of closing them. And if you understand this system, you can make the financial world work for you instead of against you. You can borrow money at lower interest rates. You can qualify for better loans. You can avoid unnecessary fees. You can use credit as a tool, not a trap. Your credit score is not the story of who you are. It's the story of how you behave. And behavior can change. If you build the right habits, protect your reputation, and understand the rules of the game, you don't just improve your score. You build financial freedom one decision at a time. And that is the simple truth behind the FICO credit score. If this breakdown helped you finally understand how credit scores really work, make sure to stick around for more Plain Explained videos, where we turn confusing concepts into clear, powerful knowledge you can use in everyday life. And if there's a topic you've always wanted to understand, but never found a simple explanation for, leave it in the comments. Your question might be the next video. Thanks for watching. Take care of your financial future, and I'll see you in the next one.